Welcome back to Quest Means Business. Now, on the eve of the decision by the Federal Reserve, the Bank of Japan has raised interest rates for the first time in 17 years, ending its long chapter of negative rates and growth measures. The bank's policy rate is now 0 to 0.1%. It's been negative since 2016. Rising wages and mild inflation made the pivot possible. The US Federal Reserve has also begun its two-day policy meeting. It's expected to hold its benchmark rate steady on Wednesday. The Fed will also release interest rate projections for the rest of the year. Raghuram Rajan is a former chief economist for the IMF and now professor at the University of Chicago Booth School of Business. Raghu, great to have you on the show. Let's talk about the Bank of Japan first. It had a sort of carpe diem, seize the moment feel about it, not just lifting interest rates out of negative territory, but abandoning some of the other measures that they've long been taken. Was now the right time to take this step?
They were waiting for inflation to start picking up. That it has done. Then they were waiting for wages, the wage negotiations that Japan has every year, to really look healthy for workers. And this time around, the Shunto wage negotiations seem to be, trending towards 3.7% on average wage growth for workers. So I think the Bank of Japan, being the last central bank to raise rates, sort of feels it's there, that inflation is here to stay. This is not a premature move. And of course, with investors seeing seriously negative real rates in Japan, it's time for them to let the short-term interest rate go up. It's a tiny move from small negative to small positive. Yes, they did abandon yield curve control that is holding the 10-year rate, but even that was not binding. They had said if it goes above 1%, we will react, but it's at 0.7 and change. So really, these are tiny moves. It's more important for what it suggests for the future.
And what does it suggest to the future about the future? Because to your point, it was a tiny move, and there was not just physical intervention here. There was also verbal, where they said, look, effectively, we're going to take this incredibly slowly and we stand ready to take action if necessary. Even the Japanese yen fell. And in this situation, surely you would have expected a little bounce, a little strengthening in the currency. But it seems investors were like, yeah.
It's hard to say why the markets did so little, but I think it is a important move from what it presages, because if they didn't take this, you would start worrying about when they would actually do it, since the wage negotiations actually came out in a direction that they wanted. What the long-term effects will be depend, of course, on where they take interest rates to. Right now, Japanese sort of households are seeing that on their deposits, on which they earn pretty much nothing, with inflation at 2 and 3%, they're earning negative real rates. Contrast that with the U.S. investor or the U.S. household who's getting 2.5% real on their deposits. So a lot of Japanese money is going outside. And what happens when Japanese rates come to a reasonable level, it's going to go back. That's going to affect liquidity in global markets. I mean, Japanese investors have been buying U.S. equities. That's going to change. But it's also going to have effects on Japanese debt. The government is one of the most indebted governments in the world, by some counts, 250% of GDP. Of course, people talk about whether it should be net or gross. Nevertheless, it's a big number. And if you raise interest rates on that big number, very quickly, the Japanese government has to pay a lot in interest expenses. And that's going to play out over time as a fiscal constraint on what it can do. Of course, lots of Japanese businesses have enjoyed really low rates. As rates go up, some of them will go bust.
Yeah, there's so much in that answer. I think your point as well, though, about the fact that we've seen the best wage increases since the early 1990s, and it barely keeps up with inflation now, is a very important point about some form of money illusion. But from one highly indebted country to another highly indebted country, and that's the United States. Don't even want to get you on the fiscal situation of the United States. Let's stick to monetary policy, if we may. The Federal Reserve not expected to cut interest rates tomorrow, but I think perhaps the forecasts now are more interesting in light of recent inflation data coming in a little bit higher than I think perhaps they would hope and others anticipated. What do you think they end up doing this year and at least telling us they anticipate doing when they produce the report tomorrow?
Well, for sure, the language will remain. We're sort of watching the data. We're going to be data contingent. I think Chairman Powell, in his last couple of public remarks, has said, well, we may be getting to the point where we will cut, but of course, he hasn't said when. And my guess is that there are two pieces of data we will see in what comes out. One, of course, is the dot plots, the famous dot plots where the members sort of say what will happen over the year. The last set of dot plots said 3 cuts by the end of the year. Maybe it goes down to a couple. Of course, it's not going to be clear when they will start. Probably mid-year sometime is the most likely guess, provided inflation cooperates. And the other big issue that they will opine on is what they will do with the quantitative easing, where the Federal Reserve is shrinking its balance sheet. Are they going to slow it down? What will they say something about when it's enough? How big a balance sheet would the Fed hold? And that's important when we start talking about things like market liquidity. Already, the Japanese decision means liquidity will be lowered through the year. And of course, if the Fed also continues quantitative ease tightening at the pace at which it's doing, that'll also mean lower market liquidity going forward.
Yeah, this is so important. The decisions of both of these central banks for investment flows around the world, really critical. Thank you for explaining it. Raghu Rajan, fantastic to have you on the show, sir. Thank you.